We're going to get started. This is a webinar about the financial planning process and understanding financial advisors and what the financial planning process is. And I thought about this webinar because one time I was at a wedding and the person next to me asked me what I did for a living. And I told him I was a financial advisor, and his first question was, "What do you sell?" And I said, if you think of your financial advisor as a salesperson, you need to reevaluate that relationship, because at the core, a financial advisor should not be thought of as a salesperson. What we do is provide advice and guidance on financially related matters, and that's really the core function of a financial advisor. So I thought I would put together this webinar to sort of explain what to expect from your financial advisor, types of questions you should ask your financial advisor, and what's involved in the financial planning process. There's many different types of financial advisors, but the best financial advisors are informed on a multitude of topics and can answer questions from a core foundation of knowledge, supplemented with analysis when needed. But for the most part, a lot of the information is something that's learned and retained and is not based on any sort of sales function. So what we'll discuss today is involved in a true financial plan, because it's a term that's loosely thrown around and I feel like it's lost its meaning. And I think that some things that aren't financial plans have become synonymous with financial plans, and I want to differentiate what the difference between a true financial plan and sort of this loose definition of what a financial plan is. So then the things we'll discuss today are what types of questions should I ask when interviewing a financial advisor? If you're interviewing a financial advisor, these are things you want to be thinking about, things that you want to get a better understanding of first, and then proceed with the interview process. You want to know we're going to go over what's involved in a comprehensive financial plan. Like I said, there's a big misunderstanding about what a financial plan actually is. We're going to talk about what it means to be a fiduciary. This was a hot topic in the last couple of years because it became news, I think around 2016, when they were trying to pass a new fiduciary rule, and a lot of that term sort of flew around the media back and forth. And then hopefully you'll get a better idea of things you could do to improve your financial well-being as well, self-assessment, and improve things to at least dig deeper into to improve your financial well-being. So I realized I forgot to introduce myself. I'm Matt Crisafulli. I'm an advisor at ACAP Advisors and Accountants. We are a boutique fee-only wealth management firm in Los Angeles. And I'll get into that, into what fee-only means in greater detail later on in the presentation. So thank you for joining me this morning. We're going to be recording this as well, so you can see the webinar on record and hear some more information about topics or points that you might have missed during the live webinar. So then we're going to talk about, what does it mean to be a financial advisor? Why do people need financial advisors? In the 1930s and 40s, Social Security came around, and that was basically forced retirement savings from the government. Later throughout time, as the cost of living got more expensive, companies started coming out with pensions. And pensions was the company's thank you for years of service working with that company. Subsequent to pensions, because those were very expensive, the 401k came about. And 401k, any other type of savings vehicle, requires the participant, or you, the employee, the saver, to know a lot about financial topics. And there's just a lot of hard decisions to be made when it comes to that arena. For example, with the 401k, you started a new company, you have a 401k to participate in. Do you participate? Is there a match? What is that match? What do you want to invest in? Does the investments that you pick match your risk tolerance? What is your risk tolerance? And then when you're filling out the application, it asks you if you want to rebalance. I don't know how often you want to rebalance, if you want to rebalance. Ultimately, there's just a lot of misinformation and a lot of hard questions that need to be answered, and the average person is not qualified to answer those questions on their own, which is why financial advisors came about. All right, so little known topic about financial advisors. There are no requirements to call yourself a financial advisor. There are financial advisors that are certified, but you listening right now could call yourself a financial advisor, and that would not be inaccurate. Whether or not you could get clients, that's a different story, but there's no specific industry requirement to call yourself a financial advisor. However, there are a number of credentials that one can get to help them deepen their understanding of the financial realm and the financial world, and become a more prolific financial advisor when it comes to understanding everything that there is out there. A lot of financial advisors have to get securities licenses, which is something that's from the state, from the in California, it's FINRA, that regulates people in the industry to make sure they're not doing anything nefarious. But in our opinion at ACAP, the gold standard for a financial advisor is somebody who's a certified financial planning practitioner, certified financial planner practitioner. If you've probably seen commercials or advertisements for a certified financial planner. So I'm going to spend a few minutes talking about what a certified financial planner is, because it really is a differentiating factor when interviewing or trying to figure out which advisor to work with. A financial planner a certified financial planner practitioner has to meet what they call the 4 E's of certification. The first one is an education component. Financial advisors need to have education background in various topics related to finance, retirement planning, investment planning, tax planning. We'll get into that in a little bit. And without that education component, you're not allowed to become a certified financial planner. Next, there's an examination. It's a comprehensive examination where they test you on all the topics that you are supposed to have learned in the education component. And if you pass that test, that's step 2 of the requirement to become a CFP professional. The next requirement is experience. They require 2 years of comprehensive experience in certified financial planning practice in order for you to call yourself a CFP practitioner. So if you see somebody with the CFP credential behind their name, that means they've already met the education, examination, and experience requirement to call themselves a certified financial planner practitioner. And then the 4th E in the 4 E's is ethics. Certified financial planning practitioners are held to the highest standard when it comes to ethical requirements in financial advising. And that's the quote unquote fiduciary standard. And I will get a little bit more into the fiduciary standard in a couple slides, because it's a very important point that I want you to be able to take away from this webinar so that you understand better the differences between different types of financial advisors. Once again, I just wanted to remind you this webinar is being recorded, so you'll have an opportunity to go back and listen to the points that I'm making here to get a better understanding of what we're discussing. So then how are financial advisors compensated? There's 3 basic compensation structures for financial advisors. The first, which, as I said earlier, ACAP is a fee-only financial advisory firm, is the fee-only model. With the fee-only model, we're only compensated by our client. We're only paid by the client. We cannot be compensated by any investment company. So we don't have to sell a product because we're not being compensated by that company to sell a product. So I would encourage you to think about it like as if we're an advisor, like an attorney or a certified public accountant or any other service provider you might have in your life, who provides a service and is compensated by you for the service they're providing. Maybe that's any service worker about you have in your life, plumber, you name it. They provide a service and you pay them. That's what a fee-only advisor is. The next way people are compensated, or financial advisors or people in the industry are compensated, is through commissions. So they can be paid based on the products that they sell. And truthfully, this is how the industry started out, which is why there's a lot of misconceptions about how financial advisors are compensated. Because many, many years ago, anybody that wanted to invest had to pay their broker a fee to do the trades for them in the stock market. Every time you did a trade, that advisor, quote unquote advisor, was compensated. There's still a lot of professionals in the industry that are paid on commission. It doesn't necessarily mean that they are recommending bad products to the consumer, but it's definitely a conflict of interest, or could be a conflict of interest, because you as the consumer is not sure whether or not the product that they're recommending is the best product for you, or if it's the best product for them because it pays the biggest commission. And then the third way advisors are compensated is what's called a fee-based advisor. Now, this term came about, it can be a little bit deceptive, but this term came about because fee-only advisors were sort of drawing people away from the advisory pool, people who only wanted to pay their advisor and not have their advisor be compensated by investment companies for recommending products. So sometimes the term fee-based and fee-only are thrown around interchangeably, but they're completely different. The fee-based advisor does typically charge a fee to manage a client's portfolio, but they can also be compensated by outside investment companies for recommending products. So again, it's not necessarily a conflict of interest, but that possibility does exist, that you're investing in a specific mutual fund or a specific investment or a specific investment product, generally insurance-based, that can pay the advisor a hefty commission for recommending that type of product for you. So be careful if you hear the term fee-based. It is not the same as fee-only, because fee-only is compensated, the advisor is only compensated by the client. If you have any questions, feel free to put them in the question dialog box. I will get to the questions at the end of the webinar. And any questions, fair game. Feel free to let me know if you have any questions. So then what are the goals of a successful financial advisor? The goal of a successful financial advisor is to grow and preserve a client's wealth in a responsible manner. We're not trying to find the next Apple or avoid the next Enron. We're not trying to find that one diamond in the rough that's going to, return 1,000% in 5 years. And we're not trying to let you avoid the next collapse of some specific stock. We're not stock pickers. We're not market timers. We're goal-based financial planners that help you develop an overall plan and stick to it. And when you develop a plan and you stick to it, sort of the ups and downs, the day-to-day ups and downs of the market are of less concern, because you're already that risk of investing is already taken into consideration when developing your financial plan. So if you are meeting with an advisor and they're talking to you about what the market's going to do in the next 5 years and what their portfolio that they're recommending for you is going to do in the next 5 years, be skeptical of that, because there's nobody that knows what the market's going to do today, tomorrow, or the next day. And if someone says they can, it's usually a red flag. And another thing advisors are capable of doing, or sort of one of our bread and butters, is protecting you from irrational decisions. When we're managing a portfolio, we understand how the market works, and we understand the risks and inherent in investing. And when the market has a downturn, we're not there telling you should be selling and panicking. We take a measured approach to how investing should be done, and using that approach, we keep you on track and prevent help prevent you from making decisions based on fear. One of the things we always talk about is how the media sensationalizes really bad days in the market and really good days in the market. And if anybody even has a secondary, is paying attention to the financial media, just kind of in their periphery, you'd catch on to this and you'll see, oh gosh, should I be selling my investments, or I should be saving more, I should be more aggressive. And that type of sensationalism is bad. We remind our clients, and I encourage you to sort of tune out that market noise and the media, and just sort of make a plan and stick to it. So I threatened I would talk about it in a little bit, and here we are. The fiduciary standard versus the suitability standard in financial planning. One of the things that came about the last few years was something called the Fiduciary Rule. And the Fiduciary Rule, let me back up for a second. The fiduciary standard has always existed, but in the end of the Obama administration, they made a rule that said all financial advisors needed to act in a fiduciary capacity. And what happened was the whole industry was sort of up in arms, because at its core and at its foundation, the industry started out as sort of a sales-based industry. These were people who made their living by selling products, and the threat of having to work in the client's best interest was going to be detrimental to the industry. The funny thing is, when this rule came out, we're fee-only advisors, we're certified financial planners. We have to work in the fiduciary capacity at all times. So when this rule came out, it wasn't a big deal for us, because this was already something we were doing for all of our clients, regardless of whether it was mandated by the government. So that was an interesting time, because as everybody sort of freaked out, we were sitting back already knowing that we were working in the client's best interest. So the fiduciary standard basically means, at its simplest, is this investment in the best interest of the client? Is this the best investment for the client? With the fiduciary standard, you're required to put a client's interest above your own. And so what that means is if I'm working with a client and I have a choice between two investments, I have to pick the one that's the best investment for that client. I can't pick the one that's a good investment or an okay investment, but is actually a little bit better for me because X, Y, and Z, whatever that might be. Usually it's a higher commission or something, some benefit to the advisor for recommending product B over product A. But with the fiduciary standard, there's no choice. If product A is better for the client, product A is the product that, or the investment that should be used. Now, this is in contrast to the suitability standard. And the suitability standard is essentially, is this investment suitable for the client? As you can see, even in the definition of suitability, it's sort of just, it's just vague. You know, is it suitable? Well, I know a lot of people who could make an argument that anything is suitable for anyone for various reasons. It doesn't necessarily mean that it is, and that's why this is such a gray area in the industry. If you're only held to the suitability standard, there's a number of things you can claim that say, yes, this is a good investment for this client because they said they were scared of the market, so I use this product. It doesn't mean that it is, and it doesn't mean that it isn't. It's just, it's too vague, in my opinion. The key distinction in terms of loyalty with the suitability standard is that if you're held to the suitability standard, your loyalty is to your broker-dealer, your employer versus the client. And at ACAP, we believe that even though it's not specifically, that's a definite conflict of interest, because if it's, you know, me against you, there's always that doubt that an investment's going to be chosen that's better for me than it is for you. So the fiduciary standard is definitely the way to go. So if you're talking to financial advisors, make sure that they are a fiduciary and that they're held to the fiduciary standard. Once again, if you have any questions, feel free to put any questions in the dialog box. I will answer those at the end. And I just wanted to reiterate, this is being recorded. So if you have any questions on stuff that we went over, it will be available online for you to look at again. So to talk about the what's involved in a financial plan, we're going to shift gears here a little bit and talk about talk about the financial plan and what's involved in the financial plan. And there's this fun little acronym that we have for retiring, and that's for a financial plan, and that's RETIRE. So a financial advisor will help you retire, RETIRE. The first R is risk management. That's insurance planning. The first E is education planning, saving for college, repaying student loans, all of that fun stuff. T is for tax planning. Financial advisors do have a big hand in tax saving strategies or tax efficient investing. The I is investment review. Do your investments match your risk tolerance? Is this a good investment? Am I paying a high fee? The second R is retirement planning. What types of accounts should I be investing in? What types of accounts should I buy certain investments in? That's our specialty. And then the last E is estate planning. We are not estate planning attorneys, but we work closely with estate planning attorneys to help you protect your assets. So all of our financial plans start out with what we call a financial review. This is all of the pieces of a financial plan, and we'll go through it one by one. On a broad level, a financial plan is an analysis factoring all the different pieces of your financial life. It accounts for how interrelated certain financial items are to one another. For example, saving in a tax-deferred retirement account saves you on taxes, but you have to pay taxes later on it. Saving in a Roth IRA, you pay taxes now, but don't pay taxes in retirement. Which account should I choose? So those are the types of questions that people come with us all the time, and that's what we're qualified to answer. We want to be thought of as the quarterback for your financial life. If you have a question or something that's come up and you want help making that decision, we want our clients to be able to reach out to us and run it by us first, so we can help guide them with a little bit of our knowledge and our experience, and if needed, an analysis. For example, if you're getting ready to buy a house and you're not sure how much you can afford, or if you can afford a certain amount but you want a little bit of breathing room for whatever reason, what amount should you put down? All of these questions that come up all the time are the stuff we want our clients coming to us first. And if it's something that's not in our wheelhouse, we have a vast network of referrals that we can refer out to, because, as I said, we're only paid by the client, so we're not beholden to any one company. We can refer it out to colleagues that have specific experience in different areas. And then probably the most important thing, and one of the most important misconceptions, is that a financial plan is not a budget. When people say you're a financial advisor, I don't necessarily go through expenses, although we have done so on occasion, to decide whether or not you're spending too much on dining out, for example. That's not where we add value. Budget is important to a financial plan because the larger financial plan requires diligent and consistent saving. So if you don't have money left over, then obviously your financial plan can't be successful. But it's not a budget because if cash flow is a known issue, then there's going to be other steps you need to take first before we can move into the financial planning process and see whether or not you're going to be able to be successful in your retirement endeavors and your saving endeavors. So. And when analyzing a budget, we have done so in the past, but at the end, I don't know whether or not it's too much money to spend on electricity or rent. I mean, those are things that the client knows, and that's not something that we can point to and say, hey, you spend too much on this, that, or the other thing. Okay. So then all of our financial plans start out with retirement planning scenarios. And this is really the bulk of the financial plan, because what it takes is all of the input of all the things you tell us, when you fill out your paperwork. And we put it into our financial planning software, and we determine the likelihood of success of your financial plan, given all of the assumptions that we make. So intuitively, people know that they need to save, but they don't necessarily know if they're saving enough. They know that they want to retire someday, but they don't know if the steps they're taking are going to get them to that retirement. And this is what the financial planning scenarios are best known for, if I can say that. If the savings that you're doing will help you reach your retirement goal. So using our financial planning software, we get you usually 3, sometimes 4 scenarios that look a lot like this. If I save this much in this account and this much in that account, how much can I spend at retirement? What age can I retire? And what's my financial plan's probability of success? People love this because it gives them confidence in that if they make the steps they're making, even though it doesn't seem like they're saving that much year over year, or that it's growing that much year over year, it compounds over time. And ultimately, at the very end, you see that your plan can be very successful, given the steps that you're taking, the steps that you're currently taking. And I think the real benefit of it is that when there's market ups and downs, obviously it can be unsettling. Nobody likes to see their accounts lose value. But with goals-based financial planning, which is what this is, based on goals that you want to achieve, you know that as long as you're taking these certain steps year over year, your plan will still be successful. Our financial planning software models in market ups and downs, so that you know that even when the Dow goes down 2% in a day or 1% in a day, that you're still set up for success. And that gives people a lot of comfort to know that doesn't matter what's going on, they'll still be successful because they made a plan and they're sticking to it. So the next part of the financial plan, once we get over the scenarios and how much you need to save, and actually, let me back up one second. One of the most important pieces of the financial plan is how much you spend. It seems like a no-brainer, but it's actually quite important. So basically, you can save all you want, but if you spend it all, your plan's going to have a 0% probability of success. But if you save a moderate amount, you sacrifice a little bit now so that you have some more in the future, and then you're spending prudently, you'll see how successful a financial plan can be. So the four components of the financial planning scenarios are what age you can retire, how much you have to save to make your retirement goals, how much you get to spend in retirement, and then that probability of success number. We strive for our clients to be kind of 80 or above. The really, really successful plans, or the people who save a lot or who don't spend that much, will be in the 90s. And then because it's probabilistic and there's always a slight chance of something happening, the highest probability of success somebody can achieve is 99%. Okay, so then once we do the financial planning scenarios, we move into the written part of the plan. Because a certified financial planner is qualified in all of those areas on the RETIRE acronym, risk management, education planning, etc. We do a written part of our plan that encompasses all those recommendations in clear and concrete written format, so that when you're going through, you see the observation that we make, you see the recommendation that we're making to sort of make you healthier financially, and then we give our rationale as to why we're making that recommendation. So you know exactly what we're thinking when we make that recommendation. So the first part of that written plan is an insurance review. We like to go through the insurances you have, auto, home, life, disability, umbrella, you name it, to make sure you have enough coverage. Do you have the insurance that you think you have? A lot of people say, yes, I have this type of insurance, and in reality, they don't. Or do you have all the insurance that you need? A lot of people say, I don't need that because I'm, for example, I'm low risk. And then all of a sudden they find out that it turns out they're high risk. I remember speaking to a client once who had a bunch of rental properties and they didn't have an umbrella liability insurance policy. And that's a big red flag. Anytime you're renting out type of property, you want to make sure that you have adequate coverage. There's a lot of exposure when you have that type of property. So essentially people don't know what they don't know. And one of the things that we help you do is educate yourself on the risks of certain aspects of your life that you may not have thought of. So it's a big part of the plan is recognizing risks and how to sort of close those gaps so that you're more protected. And the insurance planning section of our plan is usually one of the longest sections because there's so many types of insurance and so many different liabilities. And then because we're versed on the different types of insurances, we can explain to you what they mean. What is underinsured motorist coverage? What is uninsured motorist coverage? Do I need it? That sort of thing is what we go into in the plan. And fortunately, most people do have the right coverage, but if somebody's just gone through it quickly, or it's a holdover from when they were younger, and they're just like, well, that was the insurance I always had, and I just never changed it. It might be time to evaluate whether or not that needs to be shifted to be to provide a little bit more protection. So that's what we do in that section of the plan. Moving on then to the next section of the financial plan, the written part of the plan, we do an education planning situation. So I don't know if you've heard, but college is expensive, and people with children who want to help them save for it so that to avoid student loans or to mitigate some of the student loans, education planning, education savings is a big component of that. We help you figure out how education planning fits into the overall picture, if it's going to be detrimental to you, your retirement plan, if you save for retirement. In general, our firm philosophy on saving for college is that it should be supplemental to the parents saving for their own retirement, because as you know, and maybe you've heard, there's loans for college. Disclaimer, those should be taken responsibly, but there's loans for college. There's no loan for retirement. So saving for your retirement first is paramount to every financial plan success. And then once you finish college, you have student loans. What's the best repayment plan? Should I do public service loan forgiveness? Does it make sense for me to refinance? Should I accelerate my payments? All of these types of situations that come up, and people are just sort of overwhelmed with the amount of information or misinformation available out there that they don't know where to start. So sort of doing that analysis and getting down to the details on what makes the most sense given your specific situation is important. You know, there's no blanket recommendation for these types of, everything in our financial plan is completely customized. There's no blanket recommendation for anything specific in our financial plan, because it really depends on what your goals are and what the numbers say. So if you can afford to fund college for everybody, it might be successful in your plan. The vast majority of people cannot. So we sort of take a step back and say, how much can you afford to put towards college savings without hurting your retirement plan? And one of the biggest complaints we get from clients is they pay too much in taxes. I've never heard anybody that said, yeah, you know, I pay a moderate amount in taxes. Everyone wants to find ways to mitigate their tax situation, just because it's becoming more and more burdensome, especially in California where we're located. It's one of the highest state taxes on top of federal income tax. So people are always trying to find some tax saving strategies. So one of the things we'll look at in our plan is sort of tax advantage employee benefits. 401k is a big one that most people have heard of. Some people might not know about or might be intimidated by flexible spending accounts or health savings accounts. How do they work? What's involved in that? That's some of the things we'll help explore and see if it makes sense for you and at your current company. If you're self-employed, you have additional opportunities than people who are employees. If you're an employee, you sort of have available to you what your employer offers. If you're self-employed, you have a lot more flexibility. Different types of investment accounts. Earlier, I mentioned how interrelated everything is and how we don't make a decision based on one specific aspect. We take everything into consideration. this is one of those situations. Maybe your retirement plan and your investment plan and your tax picture can benefit by choosing a specific type of retirement account, a traditional IRA, Roth IRA, a non-deductible IRA. What is a non-deductible IRA? That's all the stuff that we'll explore and see if it's applicable to you, and how saving in a traditional IRA versus a Roth IRA, how that impacts the overall financial plan probability of success. Maybe putting money in traditional IRA gives you a 90% probability of success, and saving money in a Roth IRA gives you a 92% probability of success. There's, like I said, everything is customized for every client, so it's hard to say what's best, but those are the types of situations that we analyze. Are you missing out on savings opportunities? Do you understand all the different, if you're self-employed, do you understand the different tax deductions that you can take? You know, and then again, with the interrelatedness, tax loss harvesting, there's opportunities throughout the year. If investments that have been purchased go down sharply, you have an opportunity to sell that and deduct that loss on your tax return with limitation. But that's the type of thing that we're helping clients monitor or explore to sort of help them on the tax planning side while helping them on the investment side. And then another big one is the best types of investment vehicles for tax planning strategies. And an example that comes to mind is, you know, in 2018, which just ended, the fourth quarter, the stock market went down by 10-15%, depending on what sector you're looking at. And you know, there was some opportunities to do that tax loss harvesting, as I mentioned, but some mutual funds, which tend to be a little less tax efficient, had some additional tax consequences over ETFs, which stands for exchange traded funds. So understanding that the balance between mutual fund investing and exchange traded fund investing, what types of accounts these investments should be held in, that's one of the things that we take a really, really proactive approach on, to make sure that everything that you're doing makes sense, again, not as it just relates to tax planning or investment planning, but together. That's a big piece of the pie. And then probably what most financial advisors are known for, or the default, is investment review and planning. What types of investments should I be using? Are my investments low cost? What is low cost? You know, I think people have a misconception about what is low cost. And when you're educated on all the investments available out there, you understand what truly is a low-cost fee versus what is not a low-cost fee. And again, because we're fee-only advisors, or any fee-only advisor for that matter that you might be talking to, has no incentive to use high-cost funds, because those funds are typically those fees that they're charging at the fund level are compensating the advisor. Well, if you're not getting compensated by the investment, you're free to use whatever low-cost fund is available out there. So that's one of the benefits of going with sort of a fee-only advisor. Active versus passive investing. What does that mean? What types of investments make sense in which retirement vehicles? Should I be active investing? Should I be passive investing? I don't particularly like the term passive, because it sort of makes it seem like you're not doing anything if you're using passive investments. Passive investments generally just mean index funds. Funds that are invested in the S&P 500 stock index, or the Dow Jones stock index, or the NASDAQ stock index, whatever type of index that there is. And we generally use index investments, but we're very actively monitoring what's going on in each account to see if it's still the best investment for that account. And then some people who work at bigger companies or in public companies have stock options, either in stock purchase plans, or non-qualified stock options, or restricted stock units. So all of those things factor into the financial plan as well, and the overall plan's probability of success. So we factor that into the overall strategy and the overall retirement and savings plan too. So then the next part, and usually another big piece of the financial plan, the written part, is retirement planning. How much should you be saving? Why should you be saving that much? what types of investments, what types of accounts will help me reach my retirement goals? Where should I be saving? Those types of questions are things that we answer all the time. And again, back to when I first started the webinar, there's just a lot of decisions to be made when you log into that 401k account that people have over time become expected to know the answers to those questions, but there's been no education or very little education about how to make those decisions. So ultimately, people generally just don't make the decision or just do whatever the default option is that their company put them in, because at least somebody back there is making some decision and it's probably more qualified than the one I'm making, so I'll just let them make that decision. Well, unfortunately, that's not always the case. So that's one of the things that we'll help clients with is explore what those things mean and why they should or shouldn't participate. And then types of retirement accounts, that's a big one as well. We're big believers in diversifying the types of investment vehicles you're using, whether that be a 401k, pre-tax money that you've saved, that you got a tax deduction for in the current year, after tax money, that's money that you do not get a tax deduction for, but will grow tax-free. That's something like a Roth IRA. And taxable monies. Think of if you have extra savings and you want to have that invested, you put that in what's called a taxable account or a joint account. And there's different advantages and disadvantages to all three of those savings buckets. But we're big believers in diversifying those different savings buckets to give yourselves options both now and in retirement. One of the other pieces that we look at is your client's estate plan. Do clients need an estate plan? I think most estate planning attorneys would tell you yes. We're not estate planning attorneys. We're not qualified to give legal advice, but we are educated, back to those 4 E's for the Certified Financial Planner designation. We are educated on estate planning and sort of ideas with titling to help you protect your assets, minimize taxation, who should be named as beneficiaries. Hopefully you have beneficiaries on your retirement accounts. And I think part of that is educating clients on why it's important. So if we step in and they know that we cannot do an estate plan for them, and we step in and we make that recommendation for them, in our experience, it holds a little bit more weight than an attorney saying you need an estate plan. Obviously, doesn't mean it's not true, but because we're recommending it and we have nothing to gain by recommending this estate plan, clients are like, oh, that's something I should definitely look into. And we'll help explain to them why it's important. Again, we can't draft the documents for them, but we can help them understand why it's important, especially for those with property or with children or anybody they want to leave anything to when they pass away. Another big piece of the financial plan is real estate. In California, everybody wants to buy property. Property values increase a lot. And it's a big question for some of our younger clients getting into real estate. For some of our more established clients, should they be buying more real estate? And some of our older clients, should I be selling my real estate? All of these questions come up all the time, and those are things that we're helping our clients explore. Rates have gone up, mortgage rates have gone up recently, but when rates went down, everyone was asking about refinancing, if it made sense to refinance. I had a call the other day with somebody who was trying to figure out whether or not they should pay off their mortgage balance. There's a lot of analysis that really goes into whether or not it makes sense to pay off a mortgage balance. So we prefer, as I said earlier, to be the financial quarterback and have clients come to us first and ask these questions first instead of pulling the trigger or doing something irreversible and saying like, I did this, was that a good decision? Because then oftentimes it's too late, or the expense has already been incurred, or whatever the consequence of the action is, if it's not the right decision, or if it's not a decision that we would have recommended, has already happened. So that's one of the things that we help clients analyze as well. You know, and one of the, again, with the investment properties, it doesn't make sense. You know, we're big believers in real estate and kind of using real estate to diversify your investments. But if all of your money's in real estate, that's gonna cause some issues as well. So finding that balance between what you should be investing in, how much you should be investing in, and all of that, as again, according to your goals and your financial plan and your individual picture. There's no one answer that's the right answer for any of this. And then lastly, we encourage all of our clients to ask any financially related questions they might have, back to real estate questions or employee stock purchase plans or restricted stock units. How are those going to benefit my financial plan? How is it going to hurt me if I use this money? Is it going to hurt me? Being proactive about checking your credit. This is kind of the section where budgeting would come in. If somebody has issues with that, and for all intents and purposes should have the money to make their financial plan successful, where's it all going? On the rare occasion we do analyze that for people, just so they can see. In general, just as a little bit of an aside, our goal our philosophy on budgets is to quote unquote pay yourself first. And once you do that, you don't need to worry where every other penny is going, as long as you've paid yourself first. In other words, put money aside for savings, save for retirement, save for investing. The rest of it you can spend at Disneyland or wherever you want to go, because you know that you've already taken care of what's most important, and that's your retirement picture. And then I just want to reiterate that everybody's financial plan is different. So we draft these plans one by one, and they take usually a number of hours in a 30-hour range to put these plans together, and they end up being 25, 30, 35 pages long, because we're actually going through and writing written recommendations and analysis based on our experience and based on our education about what makes sense for each individual client. So that is all I have on the financial planning process and different financial advisors, but I do have some questions that I'm going to answer here now. So let me see. It says, you discuss suitable investments for clients. What types of criteria do you use to determine suitability? So suitability is just to make sure I was clear when I went through that section. Suitability standard is essentially the less rigorous standard that financial advisors use to determine if an investment is good. When we're deciding which investments to use for clients, we look at their risk tolerance. Is it the right investment for what they said they want their risk tolerance to be? Like how aggressive they want to be in the stock market, or conversely, how conservative they want to be, and that balance between the two of them. We look at what is the fund low cost? Is it going to be something that over time doesn't get eaten away by the fees in the fund level? We look at whether or not it gives the exposure to the market that we wanted. So if we're using a large company fund, like a large cap fund, like an S&P 500 fund, is that investment giving you pure exposure to the S&P 500? Is it doing what it set out to do? And then track record. Obviously, performance is important. If you're invested in again, just to use as an example, S&P 500 fund that is supposed to track how the S&P 500 index has done, did it do that? And if it didn't, why didn't it do that? So those are the types of things we're looking at when we're taking into consideration different investments to use for specific clients. Another question, do the retirement plan scenarios take inflation and large purchases into account? Yes, so it's completely customized. If you say that in 5 years you want to buy a house, your financial planning scenarios take into consideration that house purchase. It does take into consideration inflation as well. I have essentially inflation being that each year the cost of something goes up. Milk used to be a nickel and now it's $5, whatever that inflation factor might be. But that's a really, 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 really important part of the financial planning scenarios, because a straight dollar for dollar calculation year over year on how much you need to retire, quote unquote, is not going to work because of inflation. You can't get what you used to be able to get for the money that you used to. Money doesn't go as far as it used to. And our scenarios take that into consideration. So when you see that number of 96% or 80% or whatever your number is, you take comfort in the fact that what's $100 today is going to be $1,000 when you retire, and that takes that in consideration. Another question is, you mentioned that most people have a misconception about what is considered a low-cost fund. What is a low-cost fund? That depends. So I hate to be vague, but it really depends on the type of investment you're looking at. For example, you can get a fund that everybody uses that's really low cost, very, basically pennies per $10 or $1,000. Conversely, if you're trading in other markets outside of the US, those are more expensive to trade in. Doesn't mean you shouldn't have exposure to them. It doesn't mean that the investment that the fact that it might be a little more expensive is a bad thing. You need some, when you're trading in Europe or you're trading in other underdeveloped countries, it's going to cost more to do trading in those countries, or for the mechanics of the fund to operate. So it's hard to say without giving a specific, looking at specific investment and deciding whether or not that is a fair fee for the fund that you're investing in. But those are the types of things that we'll look at. Oh, here's a good one. My advisor takes a fee from my account. Doesn't that mean that they are fee only? So not necessarily. If your advisor does take a fee, you're obviously paying them. But it doesn't. You don't have, just because you take a fee doesn't mean that you're also not compensated by the investment company, and that's what that fee-based advisor definition comes in. So go back and take a look at that slide on different types of advisors, because that kind of goes into the difference between fee only and fee-based, and kind of the deception with the fee-based advisors. Here's one that comes up a lot, actually. Can't I use Betterment or Wealthfront to do what a financial advisor does for less money? If your financial situation is simple enough that you just need to put money into one account, you don't really care about the different types of investments that you're investing in, by all means, you can use a Betterment or a Wealthfront. I think they're charging like 0.35% is what they charge, versus your typical financial advisor, which charges 1%. The financial advising process, as you can see from the presentation, is much more involved than just buying and selling ETFs on the open market. It is, the comparison is night and day. The investment planning is one small piece of a much larger pie that we do. We do get that question a lot, and I'm not offended by it, but it's just completely different than just the ins and outs of buying and selling exchange traded funds and different types of funds. Plus, with the Betterments and the Wealthfronts, they require you to answer a bunch of questions that you might not know the answers to. You're sort of answering a question when you're not knowing what the answer to that is changing in your portfolio. So it's better to have somebody that really understands the questions and what they're getting at, so they can develop a portfolio based on your goals. This one comes up a lot as well. They say, my financial advisor doesn't charge me. Why would I pay someone to do something I'm currently getting for free? So it's probably not true. You're probably paying a fee. You just don't see it. With the fee-only advisor, you write a check, or you pay from your account, or pay the card each quarter. So you see that fee that's coming out, and you know exactly what you're paying for the advice that you're getting. With other types of advisors, you don't necessarily see the fee, but they're still getting compensated. And generally, it's at a higher rate than the 1% that most financial advisors charge. So keep that in mind. Nothing's for free, or as my high school government teacher said, there ain't no free lunch. And then I have one last question. What makes a good financial advising client, or how do I know if I need a financial advisor? That's a hard question to answer, but basically if you're looking at your retirement accounts, or if you've amassed a little bit of wealth after kind of saving for 10, 15 years, 20 years, and getting to your stage of your career, and things are getting a little more complicated, and you don't quite know if you're making the right decisions, I think that's a good time to reach out to a financial advisor and see what they can do for you, or if they can help you. We offer two different types of plans. We do one-time plans for clients, where we review all those documents I went over in the webinar and give them recommendations, and the client implements them. And we have another arrangement where we start off with that same financial plan, but then when it's time to implement the recommendations, we help implement those recommendations and guide the client through that process. Those are, that's called ongoing management. So it really does depend. I think it's a balance between, can I remodel my bathroom? Yes, I can, but will it take me twice as long and twice as much headache? Yes. So I think what the financial advisors offer is the ability to do things more efficiently and free up your time so that you can be spending time with your family or growing your career or just not worrying about stuff that you don't know, and you sort of outsource that to the financial advisor. I hope that this was helpful for you. If you have any questions, please feel free to reach out to us. My contact information is on the webinar. And once again, this will be posted on our website. If you want to go back and read it, feel free to reach out, email if you have any questions, and I'm happy to follow up one-on-one with any of you. And thank you for joining me. I hope this was helpful.